As new investors, the one question that comes up often is, what can we invest in? And if you search the internet, everyone will tell you they are investing in different stuff. Some will tell you they are heavily into Tesla. Others will tell you to buy the S&P 500. Some will tell you to invest in dividend stocks. When you have so many advice coming from everywhere, it gets a little confusing. So in this video, I will tell you how you can easily build a diversified portfolios with low fees, low risk, little to no maintenance needed, all while growing your wealth over the long term. Alright, let's start right now. First, let me introduce you to a fund called VWRA, short for Vanguard FTSE or World UCITS ETF Accumulating. If you check Singapore financial blogs and forums, this is the most recommended fund, the piece de resistance. Here's why. With over 3,700 stocks in this fund tracks the performance of large and mid-cap companies from developed and emerging countries from all around the world. You have stocks from US, Japan, UK, China, Canada, and so on. The holdings are diversified across many different sectors, making this a super diversified fund. The idea of investing in this fund is that you are not just betting on one company or one country to do well. Instead, you are betting on the entire world to continue progressing and improving as a whole. And that is quite a good bet because historically, this fund has given around 5% annualized return. So if you are okay with the return, great! You can just invest in this fund and close the video already. But I suspect most of you guys want more than just 5%. So let's see how we can further improve on this. With that, let me introduce to you the two fund portfolio, which consists of two funds. John Bogle, the founder of Vanguard Group and Index Funds, suggested that the two fund portfolio could concentrate on a specific market, like the US market, which gives a potentially higher returns over the long term, while at the same time having a bond fund to provide stability and give a stable income, aka diversification. An example of a two-fund portfolio is 60% in US stocks and 40% in US bonds. Or if you want higher risk and higher reward, you could use Warren Buffett Gong Gong's version, 90% allocation to the S&P 500 and 10% to bonds. The funds that you can use are VOO for S&P 500 and BND for bonds. But because they are domiciled in the US, you will get 30% withholding tax on your dividends. So a cheaper way is to use CSPS for S&P 500 and IUAA for bonds, both of which are Ireland domiciled ETFs, which have a lower 15% withholding tax. But how much more returns can we get? Here, I'm comparing an all-world ETF against a 90-10 allocation two-fund portfolio. As you can see, the two-fund portfolio gives around 9% annualized return, a slightly higher return versus the all-world ETF. However, there are two downsides to this portfolio. First, the bonds may not provide you the protection that you need. Let me explain. The whole purpose of the bonds is to provide stability during market downturns, right? As you can see from this chart, whether stocks go down or stocks go up, bonds will usually go up. But this year, because the Fed had been raising interest rate fast and furious, both stocks and bonds actually went down together. So there may be certain times when even the bonds couldn't protect your portfolio. It'd be like, protect your head. Second downside, the two-fund portfolio is concentrating on a single country, like the US. Now, I know that Warren Buffett Gong Gong thinks that this is the best investing strategy. But according to Ray Dalio's changing world order, he believes that all empires undergo a cycle, where it rises, peaks, and eventually declines. This has happened throughout history, and now the US is on a decline. So if you are holding all your investments in a single country, you are exposing yourself to concentration risk. But personally, I feel that these two risks are small because one, even though bonds went down this year, over the long term, bonds will eventually go back up. And two, the US won't just suddenly decline overnight. The decline will be a long and slow process. so you will still have time to react and change your investments. Quick pause, did you know that the Webull app has quite a lot of features other than, just buying and selling stocks? For example, you can read up on important stock news in the News tab, or if you go to the Company tab, you can check out key financials and indicators here. For example, you can see that Tesla's earnings per share has been going up. Nice. Return on assets, return on equity, income statement, balance sheet, cash flow, and there's even a peer comparison too. Also, right now, their sign-up bonus is super generous. By just depositing 2000 SGD in, buy 1 US stock or 1 ETF with a minimum transaction of 100 USD, buy 1 US option, or while maintaining a 2000 SGD net account value for that 30 days, and you will receive a $150 cash voucher reward. So, if you are interested, you can sign up to Webull using my link down below. With that being said, let's get back to the video. We can still try to reduce the concentration risk. How? You add another fund to the portfolio, making it a 3-fund portfolio. So simple. A typical 3-fund portfolio could look like this: 60% local stocks, 20% international stocks, and the remaining 20% in local bonds. Each component will play a different role. Local stocks will give you higher growth, international stocks will help you diversify your concentration risk, and bonds will reduce volatility. So, for example, if you are focusing on the US market, the portfolio will have 60% CSPX, 20% VWRA, and 20% IUAA. But here's a risk. If you are focusing on the US market, you'll be exposed to currency risk, where if the US dollar weakens against the Singapore dollar, your portfolio will boom and die. Just kidding, it won't die, yeah. You will just get back less SGD when you sell in the future. To counter that, Firepath Lion came up with 3-fund portfolio for Singaporeans. For local stocks, you could invest in either Spider STI ETF or Nikko M STI ETF. It doesn't matter which you choose because both give similar returns and both have the same expense ratio. For international stock, you could still stick to VWRA, but we can further optimize this by replacing it with SWRD, which represents developed market, and EIMI, which represents emerging market. By splitting it into 2 funds, you will now have the flexibility to adjust the weightage however you want. For example, if you are bullish on the developed market, you could do an 80% SWRD and 20% EIMI. Or if you totally don't want to invest in emerging markets, you could just do 100% SWRD. However, just take note, even though in recent times, the developed market has outperformed emerging markets, but according to investment mode, he found that there are times where the emerging market has been able to outperform the developed market. So we shouldn't just ignore the emerging markets altogether. Because of that, Firepath Lion plans to keep around 10% of the emerging market in his portfolio. Another benefit for splitting VWRA into 2 funds is that both SWRD and EIMI have a lower expense ratio, hence letting you save on some fees. Finally, for the bond component. Now, for Singapore Bond Fund, you can choose ABS Singapore Bond Fund, which invests in government-related bonds, and Nikko M Investment Grade Corporate Bond ETF, which invests in corporate bonds. As you might guess, corporate bonds give higher yield to maturity compared to government bonds. So, if you want a higher yield but higher volatility, go for the corporate bond ETF. Otherwise, you could go with ABF Singapore Bond Fund. Or you can be like,
¿Por qué no los dos?
And mix and match however you want. However, Firepath Lion decided not to invest in a Singapore bond fund because as Singaporeans, we have something similar to a bond fund, and that is CPF. So technically, every month, we are already investing 20% of our money into the CPF, which gives us a steady bond BP interest of up to 6%. So you can totally skip the bond fund if you want. But I know that the downside here is that your CPF money is locked up until you become old Apet or old Ama. You can see the money but cannot touch it. Kind of like the Din Tai Fung window thing. So here's my suggestion. One way you can invest into bonds is through our Singapore Savings Bond, which is currently giving around 3.5% now. Unlike the bond funds that I mentioned earlier, with SSB, there's no price fluctuation to worry about. The returns are guaranteed by the Singapore government, and best of all, you can redeem and get back your money within 1 month. So that's the 3-fund portfolio. A simple allocation could be something like this: 30% in STI ETF, 50% in SWRD, 10% in EIMI, and the remaining 10% in SSB. And because this portfolio is a bit more diversified than a 2-fund portfolio, you will of course expect to get slightly lower returns than a 2-fund portfolio, but with it comes lower risk. Okay, here's a quick summary. If you want the easiest way, just invest in WRA, where you are basically investing in the entire world. If you want a slightly higher return, you can use the 2-fund portfolio, where you invest in a local market like the S&P 500 and add a bond fund to reduce the risk. Or if you want some diversification, you can use the 3-fund portfolio, where you add in the international fund to diversify Gao. This portfolio will form the core of your investments. It is low risk, super diversified, and best of all, very easy to do. Once you have this core investment, you can further tweak it to improve the performance. For example, SIFE recommends the core satellite investment strategy, where you allocate 70 to 90% of your portfolio in a core position, like the 3-fund portfolio. Then you can allocate the remaining 10 to 30% of your portfolio into riskier stuff, like individual stocks, tech stocks, China stocks, crypto, and so on. That way, if the riskier investments do well, great, you will whack big. But if they don't do well, at least your portfolio doesn't jiba boom and go to zero. So that's how to build your portfolio. Anyway, that's all for this video. Hopefully it helps you out. Like, share and subscribe, as I'll be posting new videos every Monday, Wednesday and Friday.